And we started cranking. I mean, we went from $13,000 a month in revenue to $18,000 a month in revenue almost immediately. And we just started rocking and crushing our revenue projections. Good morning, or good evening, or good afternoon, whatever time it is when you're listening to this. It's morning for me, and I did something that I think I'm going to do more of. It's a deal breakdown. As you know, we are buying all kinds of storage facilities. We own 25 of them. We have 17 more under contract and one closing today, so 16 under contract. We're about to own 26. And all of these deals, I mean, many of them are grouped together. We have 15 different deals that we've closed on, and we have 10 different deals in the pipeline. All of them have their own set of projections. All of them have their own plan, our own idea, our own vision for them. They're all in different locations. I'm going to start doing some deal breakdowns. If you're watching the YouTube video, I'm going to pull up some things that you can look at, some images of our profit and loss statements, our occupancy reports, our projection documents, things like that. And if you are listening, I'm going to talk you through it because I think it's interesting stuff. We're buying most of these assets that we bought. A lot of them we've owned 6 months now, 9 months now, 12 months, or even years. So every now and then I'm going to do some deal breakdowns on some of these different properties, tell you what we were thinking when we acquired an asset, how it went, how it's going, and everything along those lines. So I made a Twitter thread yesterday about the deal in rural Pennsylvania. And this is an interesting one. It was a deal that we got under contract about this time last year, and we closed on the very last day of 2021. And the self-storage market, frankly, was a little bit different then. Not as many people chasing it. We hadn't had the big blowout 2021 yet that all the REITs have had, they've experienced now. And when I say REITs, I mean Public Storage, CubeSmart, Extra Space Storage. Those folks had blowout years in 2021, 15% same store year over year revenue growth, which is absolutely insane. It's about the same revenue growth that Google experiences. And when you're talking about a public REIT like Public Storage, that kind of massive company, we're talking $500 billion. When we're talking about that kind of volume growing that quickly and the same store revenue growth that pronounced, especially with all the new development in self-storage, meaning new supply coming on the market, new self-storage facilities getting built next door and around the corner and in the same town as a lot of these assets, for them to be growing this fast is absolutely insane. So this is a deal that we underwrote differently. This is the 7th deal that Dan and I closed on in December of 2020. It was our 3rd deal of 2020 in rural Pennsylvania, a small property. It sat on the market for probably 2 months. We put an initial offer in, it got declined. They came back to us and said, hey, would you consider, upping your offer slightly? This was about a month later, and we offered a little bit more and ended up getting the thing under contract for $1.3 million. It was listed at 1.4. And it was 31,400 square feet, and it had really low rents. It was in a small town. There were no competitors around. We were doing comps on market rent for storage, and we were having to go 10 miles out to self-storage facilities that were full. So we just did not know how much upside there was. We planned on raising rents about 30% when we closed. Ended up doing that. We thought about 30% of the customers were going to move out, but this was just an old school business. Paper ledgers, no credit cards, no online rentals. This was a town of 3,000 people, very small. We ended up buying it for 1.3. After all in closing costs and CapEx, we were all in for 1.404 million. So that was about $104,000 in extra closing costs. We financed 70% of the purchase price, 75% of the purchase price, $975,000 through a local bank. We convinced that banker to give us 1 year interest only. I think there is a prepay penalty of 531. There's a step down, and it's a 4.25% interest rate, 25-year amortization schedule, personally guaranteed by me and my business partner. We raised $225,000 of outside capital, and we put in $204,000 of our own cash into the deal. So the total cash in was $430,000. Like I said, real estate's not cheap, right? We needed $430,000 to close on this property. That's about 30% of the total cost. We did a cost segregation study. One of the interesting parts about this, we did a cost segregation study by Wes Mabry. Quick shout out if you have not done your cost segregation studies for 2020 or 2021, it's about time to get them done. On Twitter, there's a guy named Wes Mabry at 1245 Consulting, has done all my buildings, 25 of my buildings he's done cost segregation studies on, and very good, very affordable, travels all over the country. DM him on Twitter and tell him I sent you. He's busy right now, but I think he's definitely still taking on clients for this tax year. So since we closed on the last day of 2020, we were able to deduct all of that bonus depreciation. We got $314,000 of bonus depreciation on a $1.4 million all-in project. That means of our $429,000 initial investment in cash, we got a $314,000 tax write-off that year. We didn't have any profit that year, but that's the year we bought the building. That's the year we put it in service. So we almost got a full-on tax deduction, and it only offsets passive loss. I'm not a CPA. Consult your CPA, all that good stuff. But we got a full-on 72% of our cash into the deal was a deduction year one. That is the most powerful thing about real estate. Now, what were we projecting to happen? It was doing about $13,000 a month in revenue when we acquired the self-storage facility. We thought that we could raise the rents, get that to an average of $15,800 for the first year of operations. The guy who was operating it did not have a lot of significant expenses. He wasn't paying a management team. He wasn't billing his own labor. His property taxes were lower. He was underinsured. So he was only spending $45,000 a year to run the property. We were projecting more, $73,000 a year to run the property, but we thought we could raise revenue to $15,000 a month, and that would generally produce about $116,000 of net operating income year one for an 8.32% unlevered yield. That's basically the cap rate, and that's good. An 8.32%, meaning if we bought it without any leverage at all, we'd get an 8.32% cash on cash return. So our plan was to wrap the business in technology. And if you're looking at the video on YouTube right now, you can see the occupancy, you can see the new rate, you can see the total operating expense on the first 7 years of this deal. Basically, we're trying to grow from an 8.32% unlevered yield to almost a 10 by year 2, year 3. Cash on cash return, we were projecting year 1 of 17%. That's high, I know, but thought it was going to be a really good deal. Year 2, when principal kicks in, we're about 17% as well. 18% year 3, and so on and so on and so on. You can see that document right here on YouTube, or if you're watching the podcast, click in the show notes. You can see this video and you can see these documents. So our plan was to wrap it in technology, use remote management, keep our costs as lean as possible, and drive revenue. We thought we could really drive revenue. It was charging $52 for a 10 by 10. We thought market rent should be around $75. So on day one, we were going to drive rent and raise prices about 30 to 35%. So we did it, and most of the customers stayed. They didn't leave. They didn't move out. We added security cameras. We added online payment. We painted the doors, made the property look better. And the customers who did leave were instantly replaced by new customers who were willing to pay for those added amenities and needed storage. So basically our revenue stuck around. I mean, you can see this chart that you're looking at right now. We had about 245 rentals on day 1, 242 rentals a month 2, 243 rentals again month 3. We basically hung out at 88% unit occupancy, which we have a lot of small unique units that are kind of mispriced. So the actual area occupancy is more like 95%, even though you see 88 here. And we started cranking. I mean, we went from $13,000 a month in revenue to $18,000 a month in revenue almost immediately. And I mean, as you know, we were projecting 15,000 and some change. We just started rocking and crushing our revenue projections. We projected $138,000 in revenue. In Q1, 2, 3, we hit $169,000 in revenue. We beat it by $31,000 or 22%. We beat our revenue projections year 1 by 22%. And now you see a picture of our profit and loss statement. We have $169,000 in revenue so far through September and $58,000 in expenses for $111,000 of net operating income so far in Q1, 2, 3, quarter 1, quarter 2, and quarter 3. After our interest expense, we've brought in $76,000 in cash in the first 3 quarters. Our economic occupancy is 94%. We were projecting when we underwrote this deal to be about 85% or 80%. We're absolutely crushing it, and simply nobody moved out. I mean, we're driving revenue. We're trying to find true market rent, and nobody left. They're enjoying being able to pay online. We're renting a lot of new units because we have a Google My Business location, a good website, a good video on the property, things like that. So what about the cash on cash return? We have $43,000 of interest expense and $109,000 in cash flow after you take out the interest expense. So $109,000 in cash flow, $423,000 in cash invested. That is north of 25%, just a hair over 25% cash on cash return year 1. That performed beyond our wildest dreams. We're excited. And if you value it based on net operating income, the NOI of $152,000, if you divide that by 0.06, which is a 6 cap, which is about the value of this facility, even though it's in a rural market, this property is worth about $2.5 million now. We bought it for 1.3, all in for 1.4. It's worth about 2.5. We've created about $1.1 million in enterprise value in 9 months. We are excited about that. So what are we going to do with it now? A lot of people are asking on the Twitter thread, and I actually send this out to my email newsletter as well. If you visit sweatystartup.substack.com, you can sign up for my email newsletter. I send breakdowns of this once a week, once a month, however often we have some updates on one of our properties. But what is my plan now? Are we going to hold long term? Are we going to refinance? Are we going to sell it? We're probably not going to sell it because we have so much equity involved. We can pull out all of our initial cash plus some during a refinance. If we get it valued at $2.5 million, we finance it at 75%. It's going to run some back of the envelope math right here on my phone calculator, which is the most used app on my phone. $2.5 million. We lever it up to 70%. We pull out $1.75 million in debt. Now we only have $975,000 in initial loan value. So if we get a new loan of $1.75 million. We pay off our $975,000 loan. We've got about $800,000 left. We only put $420,000 of our own cash in. So we actually get all of our initial cash back plus about $400,000 to go buy and build more storage. And we'd probably lock in a longer term rate, 5 or 10 year rate, because we have a variable rate mortgage right now that we signed when we initially did the deal because we had some value to add. So are we going to sell it? I mean, maybe we could sell it. We could realize all the value. We'd get about $1 million or $1.3 million, but we'd have to pay some taxes. And most importantly, we wouldn't get to keep owning the asset and cash flowing the asset and managing it. So, these are all things that we struggle with. Is it time to refinance, pull some cash out? Definitely. Should we sell it? Are we going to hold it for a long time? There's nuance, right? I'm sure if somebody came along and offered me a 4.5 cap for 5 of these facilities all bundled together and I could make $10 or $15 million, I would have a hard time walking away from that. But right now, my goal is to own this business, cash flow the business, and hold it for a long time. Now, if you like this, if you're watching the YouTube video, there's a link down below. And if you're listening to the podcast, in the show notes, there's a link to sign up for my newsletter and get more of this stuff. If you like this, if you like these business breakdowns, I'm going to start breaking down the financials of almost all of the properties that we own. And I'm going to start doing it more often because it's driving a ton of traffic. People love it. And we're growing, man. This business is fun. Feel lucky to be involved in such a good business. We're hiring very quickly. We had 23 employees last month. We're up to 28 now. And by Christmas, we'll be over 30. It's happening. It's coming at us quick. Anyway, thanks for watching. Talk soon. Juniper Square, the sponsor of our show, recently did a capital raising survey. And in this survey, they asked 142 senior executives at U.S.-based commercial real estate firms a series of questions to understand the state of commercial real estate fundraising. It's an insanely valuable report with data on questions like, how much capital did you raise last year? How long did your last raise take? What type of investors are you raising the most from? And what strategies are working the best for you to find new investors? Download this report for free at junipersquareresearch.com. That's junipersquareresearch.com. Big thank you to Juniper Square for sponsoring the show. Thank you for listening to the Nick Huber Show. Just wanted to remind you that we have a paid real estate community where some really special stuff is happening. People are breaking down deals. People are networking. People are, I think, even formulating partnerships inside this group. We have over 100 members now. For more information, you can visit sweatystartup.com/REC. And the first 299 members of the group to get some momentum get $200 off the annual membership using the code FIRST299, FIRST 299. And also, you can check it out for 5 days for $1. You make a $1 payment, you can check out the community for 5 days. Highly recommend it if you're serious about bringing in some other people into your network, into your life to help you become a better real estate investor.